Hello friends, welcome. Friends, yesterday you might have seen that Vodafone Idea stock plummeted by 11%. Right? So this is the stock, the last closing price for Vodafone Idea, 13.43. Now, this probably got triggered by a report which was released by Goldman Sachs. Now, this report talks about the various financial metrics of Vodafone Idea regarding their debt, their earnings, and also gives a target price of the stock, which interestingly they have elevated from the earlier target price of rupees 2.2 per share to rupees 2.25 per share. Now friends, the purpose of this video is not to go through the Goldman Sachs report. Purpose of this video is different. What I am going to do in this video, I am going to take you through the fundamentals. When a reputed analyst agency is talking about a target price of Vodafone Idea so low, why Vodafone Idea is trading at 13 point something, right? There is no sense, because it has to be it should be trading at this number, because if it is an analyst report which has done so much work in churning numbers, if you look at that, there are so many charts and everything is there, so they might have done some real work. So the enterprise value and the equity value of Vodafone Idea truly should reflect their fundamentals, right? They should be trading at that, but it's not trading at that number. It is trading at a much higher value, and today I am going to talk about why it is trading at a higher value and what are the parameters in their financial statement if you alter is going to change the equation, and why. We are going to talk today fundamentals, and this video is going to be very important for those who want to understand Vodafone Idea. Not only that, but those people who want to know the fundamentals of corporate finance. Though I did a video earlier on this topic, but this is going to be pretty interesting because this is going to be a case study for Vodafone Idea. Some of the numbers will be theoretical numbers, placeholders, but the larger picture is going to become very, very clear. Because I am not here to talk about whether you should buy Vodafone Idea stock or not, because I am not a financial analyst and I have no intent to go in that direction. I am not giving any stock advice. I am just trying to tell you that how valuation of a particular stock gets impacted when a certain numbers in the financial statement gets changed, and whether when you are making those changes in the financial statement, when you are unlocking that value, and we are busy talking about fundamentals, whether the stock price should be trading on those fundamentals or not, and what are the reasons why stocks trades differently. That's the whole purpose of this video. So let's go straight to my Excel sheet. In this Excel sheet, friends, what I've done is I have created a dummy financial statement for Vodafone Idea. These are not real numbers. Some of them are, but not all are real numbers, which I made some assumptions. I'm going to talk about them. Which are the numbers which are real? The serial number 1 and serial number 2, because these are actual statement from their account statement, which the financial statement which Vodafone Idea comes out on a quarterly basis. So the revenue numbers are accurate, the EBITDA numbers are accurate, the capex numbers are not, because this is assumed that the capex to sale is 9%, because I'm just giving you an indication. I'm not doing any realistic stock valuation here. Okay. Then we have depreciation amortization numbers. These are accurate for these first 2 years. And then we have the net debt, right, which is accurate. Then interest expense is accurate. Then the PAT, whatever they have shown in the financial statement, those numbers are there. Then tax expense and the free cash flow. Now, how free cash flow is calculated? Let's talk about that, and then we'll go step by step going forward how present value is calculated and how stock prices are finally emanating out of present value. Now, what is free cash flow? Free cash flow is the cash in hand. And that cash in hand has two potential. It can pay dividend, or it can be invested further in the company to generate more assets, which will result in future cash flow. Only two things are possible, right? Or maybe a third thing, it can buy back stocks. So three things are possible. So to an equity holder, he or she is interested in what? Dividend and buybacks. And that's why when you do a present value of free cash flow, the number that you're getting, which is the present value of all cash flows for a certain number of years, when you divide by the number of shares, this gives you the share price. So let's talk one by one. First is the revenue item. Now these two revenue items which I told you is the realistic revenue item which has been reported in the financial statement for Vodafone Idea. Now for future revenue, I have assumed a revenue growth of 10%. That's how the future revenue numbers have been calculated. Now Vodafone Idea has reported an EBITDA number. EBITDA is what? Operating cost, revenue minus operating cost will give you EBITDA, right? Earning before interest, depreciation and taxes, right? That is an amortization. So these numbers are accurate, and this is basically just an extrapolation by assuming an EBITDA margin of 42%. This is the norm which I've seen Vodafone Idea in past also. They are roughly, within that number of 42%. So on the basis of which I have taken EBITDA margin. So this is the operating profit. Once you have the operating profit, you have a column called depreciation and amortization and interest expense. These two are important. Why these two are subtracted from EBITDA to come out with a number called PBT, profit before tax? Because when you calculate profit before tax, this number is important because on this number the taxation is applied, which is, let's say, 0.25, which is 25%. Because the tax that you are supposed to pay, which is also going to be part of the cash flow, is going to be operating income minus depreciation, amortization and interest expense. This is just a regulatory norm because you have to pay taxes after deducting from the operating income depreciation, amortization and interest expense. Therefore, depreciation, amortization, which is a notional item, has been taken into consideration in the financial statement. Otherwise, it is not a real cash flow item. The real cash flow item is interest expense. So once you have this interest expense and you apply the tax expense, you come out with PAT. Once you have the PAT, then you have the free cash flow. The free cash flow is not the PAT, by the way. It is going to include what? The capex also. Because the cash that you get in hand, you will make some capex expenditure, which is also going to result in cash outflow. And that cash outflow which you are going to incur should be deducted from the final cash that you have in hand after paying taxes. So that's the free cash flow. Once you have the free cash flow, what you do? You then have to discount these free cash flow, right, in various interval of time using a discount factor to come out with the total present value. And that present value will get divided by the number of shares, which will give you the share price. Now you see a negative share price here. Don't get scared by that. And I'm going to go into the details to explain how discounting is done and how these numbers can change to positive and why it is positive. Because this is actually 13 point something, right? It's trading positive. Okay. And what Goldman Sachs is saying, this number should be 2 point something, right? 2.5 or something it mentioned in the report. We are going to talk about that. Now, after having understood how free cash flow is calculated, we need to understand how the discounting factor is calculated to able to discount this free cash flow in various period of time. Because why do you discount? You discount because the time value of money has to be taken into consideration. There are two factors here to understand. First is that the certainty of this cash flow is not there. Two reasons. One is that inflation is going to devalue the amount of money, because if your money is not getting available to you in the same time period which you are standing right now, you will have to deal with inflation and you have to deal with what? Uncertainty, risks of those cash flow coming to you or not. So both this factor has to be taken into consideration while calculating the discount on which the cash flow will get discounted, which will result in this final total present value of all this cash flow on which the equity value will be calculated. Now this is the cost of equity which you see 27.96, and how it is calculated, let's go into that detail. Now before I go into and understanding the cost of equity, one important concept has to be understood. What is that? What is risk-free rate? Risk-free rate is a rate when you invest in an asset which is risk-free, where the returns are guaranteed. So let's ask, what is the asset class like when you make investment where the returns are guaranteed? It is it is not a corporate bond, it is the Government of India bond or a national bond. Because when nation is going to give you sovereign guarantee of those cash flows, which is the interest payment which you receive for investing in, or the yields which you receive when you invest in a debt instrument of the government, which is, let's say, 10-year bond, that is considered to be a certain, almost like a risk-free investment, because the returns are certain, because the Government of India is giving you backing. Now the problem is that no country in this world can be considered as default free, because there have been nations which has defaulted in past. So what a credit agency does is it gives a rating for that particular country. On the basis of that, I have taken a default spread for India as 2.64. This number is not an accurate number. This is changed. This is an old number. Okay. So now what is the risk-free rate? The risk-free rate is now 7%, which is the yield value of a 10-year government bond, minus this 2.64%. So it comes out to be 4.36%. This is the risk-free rate. Now, why this 4.36% is the risk-free rate, and what does it mean? It basically means that to a well-diversified investor who is investing in such instrument, he or she needs to make at least 4.36% of return to stay afloat, because he is going to be diversified across all nations. So there will be certain countries going to default. So in those countries, he is going to lose that money he has invested, and he will make up for those losses in other countries, and therefore he has to make up for those losses, and therefore he has to earn minimum 4.36% of return in order to stay afloat. That's the meaning of this default risk and all those things which I told you. Now, after having understood that risk-free rate, okay, let's understand how cost of equity is calculated. Now, for calculating cost of equity, you need to have a concept called equity risk premium. Now, what is equity risk premium? Now, equity risk premium is the risk of investing in equities. As simple as that. If you are investing in bonds, you would definitely earn a return of 4.36%, which we have discussed. Now, if you invest in equities, you need to earn more returns, because equities are going to be more risky. Simple, right? We have to now understand what is that more. How much more return that you need to earn in order to ensure that a well-diversified investor, when he invests in such companies of different types, of different risks, he stays afloat, because he recovers the losses which he is definitely going to undertake in some of the companies from other companies by extracting more returns than normally he would have earned when you do risk-free rate. That's the concept. So how do you calculate that? Let's understand this. Now, in order to calculate that, I will not go into any corporate finance jargon. I am going to make it very simple. So let's understand simply with simple. Let's take a index. Index is a well-diversified index. Means it consists of lot of stocks. Now, that index, if you have a history of dividend and buybacks, because there are index where you do not have that data. For example, in Indian Sensex, we don't have the buybacks and the dividend data with that level of accuracy which we have for US. So let's assume that when you take the US index and then do the same calculation of cash flow, which is what? Dividend and buyback, you will be able to accurately calculate what is the present value of that particular index, right? Because index is the value of the index will keep on changing over a period of time. Historically, you have seen that Now you know how much return that you made on dividend and buyback. So when you do the discounting on those within X, you don't know the discount factor, by the way. You can basically keep on saying that, X is my discount, right? So you basically do what? Let's say year number 1 is, let's say if the index is of 3000, right, level, then you have to do present value is what? Present value is 3000 divided by 1 minus X to the power 0, right? Similarly, if let's say it goes to 3500, then it is 1 minus X to the power 1, like that, right? That's how we can, sorry, not divide, it actually will get multiplied because the present value numbers were going to get reduced, right? So that's how you're doing it, right? So once you know that today my index is valued, let's say at 4000, you will be able to, you can solve the equation using a computer and get the value of X. So when you do it for US, this number comes out to be 5.27. This is again an old number. This is not a new number. So what you can do now on this is the US equity risk premium, and US is considered to be risk-free market. Now if you add the default spread of Indian bonds, not the equity, it is 2.64, which we have already seen here, 2.64. Now this is again for bond. For equity, you have to multiply by the standard deviation of equity and divided by standard deviation of bond, because equity is more volatile. So what happens is that when you do that calculation, Damodaran has done it. I've taken from Damodaran. It is 1.4. So you multiply this number. So what happens is that let me just show you how the calculation is done here. This number plus this number C49, 2.64 multiplied by 1.4, you get the ERP for India. That is the equity risk premium for India. Got it? Now let's go to our Excel sheet after having understood this. Now you see this 8.97 number, but how do I get cost of equity now? You have this number now, you know the India risk-free rate is 4.36, you know that it is the Indian ERP is 8.97, and now how do I get the cost of capital? That's the point which we have to understand. Now here is a very interesting corporate finance concept. When you know the ERP is of the overall index. Assume that if it was BSE Sensex, its ERP equity risk premium is 8.97%, which we have extracted from the US market of S&P 500, which I showed you right now. Now this is for the index, but index volatility versus the stock volatility will be different. When you say volatility, what is volatility? Volatility is the uncertainty of you. When you liquidate the stock, you will be able to make return, because if the stock is going to move like this, let me just give you an example, because that will make clear. Your index is moving like this, let's say, and your stock is moving like this. So then you are not sure when you are going to sell the stock. Either you are going to sell it here or you sell it here. So this risks of volatility of the stock is captured in a concept called beta. Because the beta is the number which is going to reduce the equity risk premium or increase the equity risk premium depending upon whether that is volatile, more volatile, less volatile than the index. So again, I am taken for a telecom stock which is considered to be less volatile. I have taken it as 0.92. This is again from Damodaran, right? It is an industry specific number. So let's assume that your company doesn't have any debt, because debt is going to increase this volatility further, because the interest payment is going to add another level of risk. When the business may not be doing well, but you have to keep paying interest, therefore your volatility of your stock is going to be much higher, because interest outflow will be there, income is going to be there. So assume that you have no debt. So this is the normal beta of the industry. Assume that there is no debt. But if there is debt, then the number of beta is going to increase, and there is a calculation for it. And I don't want to spend my time doing this calculation here. It depends upon debt to equity. And you just will get a sense what is debt to equity, because debt to equity number gives you a indication that how much additional risk that you are carrying in the company, which is going to increase the volatility of your company versus a normal index to a much higher level. And that is what is going to increase your risks of carrying that stock. And that's why the cost of equity is going to increase because of the debt to EBITDA, debt to equity number, which in case of Vodafone Idea is 2.48, because I have calculated the market value which is the market cap number and the market value of debt. I don't want to get into market value of debt calculation here, otherwise the video is going to get too long. So this number is 2.48. Now the cost of equity is going to be what? Simple calculation here. You just have to add the India risk-free rate, you multiply, and then on top of it you add the India ERP, which we have seen how it's calculated, and multiply the levered beta. Because this levered beta is indication of additional risk that you're taking because you're carrying debt. That is a very important concept one has to understand. And now let's play with the number. Now you will see. Now what we have done is, in this sheet, if you see, debt to EBITDA number of Vodafone Idea, if you do the calculation, debt to EBITDA is coming out to be roughly 13 point something. So for the following 2 years, I have assumed debt to EBITDA number for the 2 years, which is a certain number, 14.9. Now for the later years also, I am assuming for 13.49. But let's assume that I take this number as 2, right? And I just drag it as 2 down below. But this is only changing what? This is changing the interest expense. But I have to do additional one more thing. What I have to do now, because I have reduced this number as 2, my net debt number has reduced, right? Because this debt to EBITDA, it's EBITDA number which I have seen, we are keeping constant. My net debt number has reduced. So what I am going to do, I am going to copy this debt and I am going to put this here and say values. Once I do that, my cost of equity number has, see, share prices have increased to 18.05 of Vodafone Idea. Now you understand what is the reason why Vodafone Idea is trading at a higher number compared to what its real value is. When what a Goldman Sachs is saying it is going to trade as 2 or 2.3, I find it little funny. You can't make those accurate calculations because for Vodafone Idea there are two main assumptions here. What is the assumption here, Vodafone Idea? The main assumption here is that the debt to EBITDA number is going to change because the debt that Vodafone Idea is carrying, which is 2 lakh crores, that number is going to substantially reduce. When that debt number gets substantially reduced, two things happen. Your interest expense goes down, right? That's how our free cash flow is going to increase. Another thing that will happen is that your overall risk of carrying the equity is also going to go down. So your discount factor is no longer going to be 27.96 for the equity. It is going to go down and therefore your present value is going to increase. Do you understand now why Vodafone Idea is trading at 13, 14, 15 rupees per share and not negative? If you do the foundational calculation for Vodafone Idea and assume that nothing is going to change, the debt to equity capital numbers are going to remain the same, the debt is not going to go away, then you will basically have to make the Vodafone Idea's equity to 0 because it has no value in real sense. Whatever Goldman Sachs is saying is fine. Even 2 rupees is also not going to be the value. I don't know from where the 2 rupees has come. If you do the actual calculation, it should come out to be negative. But the most important thing is their net debt number. This has to go down significantly in order for Vodafone Idea overall equity to go up, and the capex outflow also is important because this is the real cash flow which the company has to undertake on an ongoing basis. So this is not a real valuation exercise. I am not helping you to do real value. I am just showing you that why Vodafone Idea is trading at a higher value, and when you are mechanically putting out reports which is kind of giving a sense of a picture to a novice investor who doesn't understand all these details as to something is severely wrong. See, Vodafone Idea is fundamentally, because of the government debt, even if their revenues numbers are higher, their stock prices are always going to be at a very low value because of the interest expense, which is going to be pretty high. And that interest expense has to be converted into equity, that debt has to be converted into equity. And when you do equity conversion of those debt, this interest expense is going to go away. Once this interest expense, let's say if I remove this interest expense, let's say assume make it 0, you see how their stock prices immediately is going to increase to a positive value. But this is not the actual calculation because I have to make this debt also go to 0. Then you see cost of equity is 12.6%. This is going to trade at 32.22 rupees per share. Okay, friends, do you get the picture where the things are coming from? And that's why I wanted to do this on a foundational basis, because unless you look at the concept, doing multiples makes no sense. It is fine, you can do multiples. But again, when you are doing foundational analysis of company, it does not mean the company is going to trade at that real market value of that company, because it's a demand and supply equation. Even if your fundamentals are strong, if there is no demand for the stock is going to be continuously get hammered. So stock market is not about the whatever is trading in the marketplace. Stock investment is actually about understanding the fundamentals and staying invested for a longer period of time with an assumption that market is finally going to unlock value. This is not just true about stock market. This is true about individuals too. When you meet an individual who you don't trust, he may have a huge amount of value to unlock, but you will not attribute. Like if you are going to a company for employment, company is going to pay you the minimum. But as soon as they start realizing that you are a superstar, your salary is going to go up significantly. Similarly, stock market also functions in this manner. Friends, I hope that you have understood what I'm talking about, what I actually wanted to talk about. And this is important to understand for all who are basically looking at these things carefully to understand. And I thought, this is my contribution so that, people can understand where the things are. So thank you, friend, for your time, for listening till the end. And I'll come back to you with a new video next time with an important topic. Thank you very much.